Have you heard? East Africa Breweries Limited, EABL, the company behind drinks like Tusker, Guinness, and Johnnie Walker. EABL wants to raise 20 billion shillings through a new corporate bond. But here is the real question. Why is one of Kenya's biggest companies borrowing billion again? And what does it mean for you, the everyday investor? Let's break it down, simply, clearly, and without the finance jargon. So, what is a corporate bond? A corporate bond is just a loan that the company borrows, but from investors like you, not from banks. This means that you, the investors, lend money to the company. The company promises to pay you back with interest. EABL did this before. In 2021, they raised 11 billion shillings through a bond. But they paid it off early, before it was due. Why? Because interest rates were changing, and they had the money. So instead of paying extra, they cleared the debt. Now they're back, asking for nearly double that amount, 20 billion. So why take another big loan? Because business growth costs money. EABL says they'll use this bond to fund operations, refinance debt, and expand capacity. Basically, to keep production strong, pay off old loans, and invest in the future. It's like taking a smart loan for your shop, not because you're broke, but because you see opportunity. And here's the key insight. When big brands raise money through bonds, it's a vote of confidence. They're saying, we trust investors more than banks. If this bond succeeds, it could spark a wave of confidence in Kenya's capital markets. Imagine Matatus on a new route. Once the first one fills up, others join. That's what could happen here. More companies could follow EABL's path and issue their own bonds. Right now, most investors only know treasury bonds, safe, government-backed. But corporate bonds have struggled because of past defaults. If EABL pulls this off smoothly, it can rebuild trust. And that trust could unlock billions in private investment across Kenya. Now let's talk about you, the investor. Why should you care? If you buy a corporate bond, you're lending money and earning regular interest. Let's say EABL offers 11% per year. You invest 100,000 shillings. That's 11,000 shillings in interest annually. Compare that to a savings account that pays 3 or 4%. It definitely makes more than a savings account. But remember, your cash is locked in for a few years. It's not like M-Pesa where you can withdraw any time. Think of it as planting a mango tree. It takes time, but the harvest is worth the wait. If you found this helpful, be sure to hit that like button and subscribe for more simple breakdowns of the financial world. Now, every investment has two sides, the sweet and the sour. Let's talk about the main risks. But like any investment, this EABL bond comes with its own set of risks. Let's break them down so you know exactly what you're getting into. First up, there's interest rate risk. Imagine you buy this bond today. What happens if, a year from now, the central bank raises interest rates? Newer bonds will be issued with higher returns, which makes your existing bond, with its fixed lower rate, a little less attractive. If you wanted to sell it, you might have to do so at a discount. It's like buying a phone right before a new model with better features comes out. The value of your older model instantly takes a small hit. Next, we have credit risk. This is all about EABL's ability to pay you back. Now, EABL is a giant with a strong history, but no company is completely immune to challenges. Think about it. What if there's a sudden hike in taxes on alcohol, or a major economic downturn that leads to lower sales? Any significant financial trouble could, in theory, impact their ability to make those interest payments or repay the principal on time. It's a low probability for a company like EABL, but it's a risk you have to acknowledge. Finally, there's liquidity risk. This one is particularly relevant in the Kenyan market. Liquidity is just a fancy word for how easily you can sell an asset for cash. Unlike stocks, which you can trade in seconds, corporate bonds in Kenya can be a bit tricky to offload quickly. If you suddenly need your money back before the bond matures, you might have to wait to find a buyer, and you might not get the price you want. It's not like withdrawing cash from an ATM. It requires a bit more patience. That said, when you stack all this up, EABL's solid brand reputation and decades of strong financial performance make it one of the more reliable issuers in the entire East African region. The risks are there, but they are balanced by the company's robust standing. Now, let's zoom out and look at the bigger picture, because this bond isn't just about earning interest or backing a beverage company. It is a sign of something much more important: the growing maturity of Kenya's financial markets. Think about it. When a massive local company like EABL decides to raise billions of shillings from its own people, right here at home, that money doesn't just vanish into a corporate vault. It gets put to work within our economy. That capital stays here. It's used to build and upgrade facilities, to hire more workers, to innovate, and ultimately to pay taxes that fund public services. This process is called local capital formation, and it is the engine of sustainable economic growth. Instead of relying solely on foreign debt or investment, we are fueling our own development. This creates a powerful cycle. Local investment leads to local growth, which in turn strengthens our national economy. But perhaps the most exciting part of this story is that it opens the door for everyday retail investors, people like you and me. For a long time, opportunities like this were reserved for big institutions. Now, you have a chance to do more than just be a consumer of products. You can become an investor in the very companies that are shaping our country's future. You're not just spending money. You're putting it to work, participating directly in building the nation. As the saying goes, when we invest locally, we grow collectively. It's a powerful shift from being a spectator to being a player on the field. So, after breaking it all down, the potential returns, the risks involved, and the bigger economic impact, the final question lands back with you. Would you consider investing in EABL's corporate bond? Do the steady, predictable returns appeal to you, despite the risks we've talked about? Or do you feel more comfortable keeping your money in a savings account at the bank, where it's more accessible but likely earning less? There's no single right answer. It all comes down to your personal financial goals, your appetite for risk, and where you see the best home for your hard-earned money. It's a fascinating choice to have, and a great conversation to start. I'd love to hear your thoughts. Drop a comment below and let me know what you would do. Are you Team Bond or Team Bank? Thank you so much for joining me on this deep dive. If you found this analysis helpful and want to learn more about making your money work for you, make sure to hit that like button and subscribe to the channel. We've got a lot more to cover. See you in the next one.